Perfect. I'm going to share my screen real quick. Right. Awesome. All right. Hello, everyone. It has been a couple years since I've been in your office via Zoom, but excited to be here. My name is Adam Nishikawa. I work with Exchange Resources. We're a 1031 exchange qualified intermediary that has been here in San Diego for 25 years now. Personally, I've overseen about 3,000 1031 exchanges and counting, and I've seen just about everything. So I'm excited to kind of go over a few of the basics quickly, get into some situations, and hopefully answer all of your questions. I really want everyone to leave with a really good resource for the 1031 exchange, and hopefully you feel even more confident the next time an investor gives you a call after the seminar. Big thank you to Lindsay for having me in again. Always excited to share. I don't have a ton of knowledge, but I do know the 1031 exchange. So this is my niche. I always like to start with a definition of the 1031 exchange. So the 1031 exchange is a specific part of the tax code, and it's going to allow an investor to defer the payment of those capital gains tax as long as they're exchanging investment property for like-kind investment property. So really unpacking this definition, the first part is this is for investment property only, and that's proven on their tax return. So however they've been filing taxes, that's going to be what the IRS looks like for the qualification of being an investment property. The second underlying part there is this is a deferral program. So the saying in our business is defer, defer, die, because your heirs will get that step up in basis. This is a tax deferral. So this is not tax-free. This is kicking the can down the road, so to speak, and utilizing those tax dollars for the future. And the third underlying word there is like kind. So this is for real property investments. So that's super broad. Like kind, most of our clients, they think if they have a single family home, they have to exchange into a single family home. But fortunately, they can exchange into any qualified use of the property for investment or business purposes, meaning land, single family homes, condos, oil and gas rights, cell phone towers, multifamily, commercial. They're really not limited to what kind of investment property they buy, which is nice. So it's a really broad definition, and it allows those investors to defer all of those capital gains taxes. The first question you'll get is, well, what are these capital gain taxes? And just like you, I refer them to their CPA to get this answer. Please go talk to your qualified tax professional to get to your personal tax liability for this property. But an overall breakdown of what that tax liability looks like. The first one, the largest number you see there is that long-term federal capital gain tax. So this is up to 20%. It's based on their income bracket. And this is long-term capital gain from the federal level. The second number there is the affordable healthcare surcharge tax, which is 3.8%. That's any investment sale over about $250,000 is going to qualify for that. So pretty much any property in San Diego. Depreciation recapture. So if you have any investors, let's just say they've owned the property for 10 years and they've been taking depreciation on the property for each of those years, they would actually have to pay 25% of that depreciation back to the government as sort of like a back tax. So depreciation recapture is a big one that kind of shocks people. There's the state capital gain tax. So lovely California has the highest state capital gain tax in the country at 13.3%. So all of these taxes are pretty significant. So usually when an investor contacts me and doesn't understand this and they're not sure if they're going to do a 1031 exchange, I refer them to their CPA, and their CPA will give them a range of this is what you will likely owe when you sell this property. It's usually a big eye opener, and it has been a good tool to sort of let them know, okay, the 1031 exchange is going to be the right option for me based on how much they would have to pay in taxes. So the potential tax liability is huge, especially here in California. So it's definitely something I recommend you partner with your client's CPA to help them get that full understanding. So there's no surprises, if they decide to just not do a 1031 exchange and get hit with that tax bill, that way they're in full understanding of their overall liability. Holding title during a 1031 exchange. So the people that are allowed to use a 1031 exchange are investors, and that is proven on their tax returns. And they want to make sure, the federal government wants to make sure that the person utilizing the 1031 exchange is the same person from the sale property to their new exchange property. And they track this using their tax ID number. So this is important because when you have an investor that sells an investment property, they need to make sure that they buy the replacement property in the same manner. So this means if they were using a revocable trust, if they were using an LLC, if they were using any of these potential entities that may have a separate tax ID number, they need to understand that if they sell under that tax ID number, they need to purchase under that tax ID number as well. So this is another reason to get their CPA involved, because holding title is really important. If they change title during a 1031 exchange, it can cause complications, and those complications can include potential tax liability. So one example, if you have a client that's in a general partnership and they own stock in a corporation, essentially, the 1031 exchange cannot just be them individually. They would likely have to do it as the corporation, or they would have to go through a potential lengthy process to deed the property into tenants in common and then do a 1031 exchange from there. So there's a lot of situations that can be complicated, and they all stem from holding title. And we've all had clients that have lied to us about being the only person on title to their property. And then you pull title and you find out, okay, who are these other people that are on this property? So it's really important that they understand and that you're able to help guide them through the title holding process of the 1031 exchange. So there's a few, I kind of want to get into the different 1031 exchange options before I kind of go into some of those situations that I listed on the little flyer that Lindsay sent out to everybody. So the first is the delayed exchange. This is by far the most common style 1031 exchange. This is 95% of my transactions are delayed exchanges. They're also sometimes known as straightforward exchanges or starker exchanges. And this is a traditional exchange. This is a sell first, buy later timeline. So you'll notice the planning and consulting stage. This is when they're talking to you. This is when they're talking to me. This is when they're talking to their CPA. They're getting all of their ducks in a row so there's no surprises when they sell their investment property. You're going to list this property just like any other property. You, of course, have to declare that's a 1031 exchange. There's some standard CAR form regulations as far as paperwork to fill out. But the 1031 exchange is set up prior to the close of escrow. So our company has to have a exchange contract in place before escrow closes. And that's because when escrow closes, those funds are either going to go to the client, which would be a taxable event, or they're going to come to us. And escrow needs the directions on where those funds are going. Once escrow closes, that's the trigger for the time frame. That means that if escrow is 60 days, and they're looking for a replacement property, their time frame has not begun yet. So close of escrow is the beginning of the time frame. The first part of the time frame is 45 days. This means that your clients have 45 days to identify a potential replacement property. 45 days goes by very quickly, and those are calendar days, so those are not business days. So at the midnight of the 45th day, we have to have a finalized identification form in our inbox. If it's after the 45th day, it's after midnight, it does not count. So it does have to be completed before the 45th day. The two options are the 3 property rule and 200% rule. After this seminar, I'm definitely going to send Lindsay a 1-page exchange guide, which is really handy to give to your clients and kind of go over just the general basics, as well as a sample escrow expense outline. And if you would like an identification form to kind of see what that looks like. But the most common option is that 3 property rule, meaning you can identify up to 3 potential addresses. Now, your clients must purchase one or all of those addresses by the 180th day. So just shy of 6 months to complete the exchange. The 3 property rule does not have a limit on value. So those 3 properties they identify could all be crazy values or all be different values. The alternative to doing the 3-property rule would be the 200% rule. The 200% rule essentially means that if your client sells a property for $1 million, you subtract closing costs. Let's just say you're at $950,000. Well, your clients will be limited to 200% of their sale price, or that 950,000 times 2 of total identified property. So they can have more than 3 properties, but the value cannot exceed 200% of that $950,000 in that example. So for some clients, this makes a lot of sense. Like I have a client that if they sell a big multifamily investment property and they want to find a bunch of single family homes in Palm Springs or out of state, then they'll use the 200% rule. But the 3-property rule is, I would say, used most common and definitely gives them the most flexibility when it comes to the values of the properties. So the delayed exchange, 180 days. This is the transaction in a nutshell. I will say from a success standpoint, it makes the most sense to start looking for the replacement property just before they close escrow on their sale property, because you want to make sure you're making offers. They're going to be, of course, if it's before escrow closes, contingent upon the sale of their investment property. But if you get really close to that deadline, you kind of know, okay, you have an estimated amount of funds that's going to be coming from escrow, and you kind of know, okay, here's how much we're going to be able to put down towards this purchase. You can kind of include some of those numbers in your offers. Of course, if your clients need to pay an earnest money deposit before they have funds from their sale, that's okay. They can use personal funds to put down on the replacement property. And then once escrow closes on the sale and we're holding those funds, we can provide a reimbursement for any earnest money deposit that they've used. So that's one way to it's all timing, just like all real estate transactions are all timing, but definitely high success rate with investors that are looking before their 45 days begins, because that time goes really quickly. And I hate to get that phone call on the 42nd day. What do you think of Palm Springs? Or what do you think of this part of San Diego? And I'm like, well, that's not my responsibility. That's, and also, you have to give me the actual property addresses by the 45th day. So it goes very quickly. But that's the delayed exchange in a nutshell. Any questions on the delayed exchange? I can look at the chat. Yeah, so out-of-state property, the 1031 exchange is allowed for anywhere in the country. So you can exchange from California to Oregon to Texas, wherever your investor may want to move their property. 30% of our 1031 exchanges as a company are out of state. So it's not something to be surprised if your clients want to do that. But yeah, definitely allowed. And one thing to know for out-of-state 1031 exchanges is because you are deferring the California capital gain tax, your CPA will be filing a reporting form at the end of every year, just letting the franchise tax board know that their taxes are deferred. If they ever stop filing that form, or let's just say they sell that property and they decide to not do a 1031 exchange and just pay the taxes, at that point, California will want their taxes from that deferral. So it is important that they understand if they file their own taxes, they have an additional reporting form they have to do. But hopefully they have a CPA and the CPA will do it automatically. Great question. Oh, another question.
Can I ask a quick question?
Yeah, please.
So if you're deferring by exchanging to out of state, say to Michigan or whatever,
Yeah.
and then you sell in Michigan or you end up using that as a family home in Michigan, at that point, you have to pay the state tax from California?
Yeah, if you ever do a traditional sale in the future, then you would have to pay California their tax from when you left. So whatever number you
Tax
owe
and the
California,
Michigan tax all at the same time. Huh?
yeah. So unfortunately, you would have to pay all of the taxes at that time. But if you did another 1031 exchange and say you left Michigan and you went to Arizona, then you would keep deferring all of the taxes, even from Michigan. So whatever tax liability you accumulated there would also be deferred.
Okay.
Great question. And I'll be going over conversions as well in a few slides, so everyone can see that. I know I promised a little more of a advanced 1031 seminar today. So next up, we have the reverse exchange. So if a delayed exchange scares your clients and they feel like, I just don't want to risk not finding something in 45 days, we have this option called the reverse exchange. It allows an investor to purchase the replacement property before they sell. So you're literally flip-flopping the time frame. The time frame begins at the close of escrow on the new purchase. They will have 45 days to identify which property in their portfolio they plan on selling. And then they must sell that property by the 180th day. They must close escrow on the sale of their property by the 180th day. So this does allow for investors to guarantee they find the perfect property. So if you have an investor that comes to you and says, this is what I'm looking for, there's nothing available at the moment, they can wait until it is available, and then they can purchase it and then do a reverse exchange. Now, I will mention it is a much more expensive process. Our delayed exchange, we do a flat fee. It's $1,250, one sale, one purchase. That includes fidelity bond, insurance, qualified trust account, everything. It's a flat fee. But if you do a reverse exchange, it's $8,000. So it's a lot more money, but it also guarantees that the client does not have the risk of not finding their perfect replacement property. So we really don't get it. You'd be surprised how little pushback we get on the fee, because it's a way to avoid a lot of the stress of not being able to find the replacement property. You'll notice there's two options there, option A, option B. So the reverse exchange, the reason why it's done by our attorneys are because it is a little more of a complex process. The federal government does not allow the taxpayer to stay on title to both their new property and their sale property at the same time. So we have to park one of those properties in a corporation, and it's just temporarily. But option A is parking the relinquished property, meaning the one that they're selling. That's usually pretty easy. We do the research to make sure that the city or county transfer taxes don't get triggered if we park that property. But we do that because if your client is using financing for the purchase, no lender will let us take title to that property. So that's where option A would be used. Option B is when the replacement property is all cash. We'll just take title to that. It's not a big deal. It makes that process really easy. So any questions on the reverse exchange? It was really popular, if you remember, like a year and a half ago when bidding wars were crazy and people could not lock down properties for their life. Like there's 30 bids on every property. The reverse exchange was a huge benefit to help guarantee that the investor was able to secure the replacement property of their dreams, basically. So for the right investor, if they give you the reason they're not going to let you sell the property because they don't want to do a 1031 exchange traditionally, because they're just scared about the 45 days, this is an option to make it happen. So definitely something to keep in your back pocket. So a few of the topics, I wanted to bring up some situations for the 1031 exchange, because like any sale of real estate, there are certain situations that trigger different results. And I think one of the topics that I've gotten a lot, especially recently, was what happens to an investment property during and after a divorce. So what happens in a divorce is there's three situations that usually happen. So if it's a really amicable divorce, situation A is one spouse, which is currently held as a joint tenant because they're still married, can sign a deed naming the grantor spouse as the owner of 50% tenancy and common interest. So they can kind of divide it early, kind of if divorce proceedings are not done, they can do that separation pre-divorce per se. Situation B is usually when divorce proceedings have completed and joint tenancy is typically severed as part of the divorce. And so what happens is, again, this goes into a 50% tenancy and common interest. And what happens is typically under a 1031 exchange, if you change title on a property, let's just say you have a general partnership and you have 3 partners and you drop it into tenancy in common. Well, typically you would have to let that ownership, I guess you would say, season. And so some CPAs would say 13 months. Some CPAs would say wait the full 24 months before you do a 1031 exchange. And fortunately, the Internal Revenue Code 1041 does allow for that divorced couple to sell the property immediately, and they can actually do separate 1031 exchanges, meaning one spouse can go take their 50% and do a 1031 exchange into their own property they want as an investment, and the other spouse can take their 50% and do their 1031 exchange separately. So that the nice part about that is it does allow for them to kind of divide up those assets and move them into their own, especially if they're not maybe on amicable terms. It's nice to separate that so they don't have to deal with that in the future. Situation C, maybe the settlement agreement requires one spouse to transfer an interest of the exiting spouse. So that conveyance would actually also, under IRC 1041, would not trigger any tax liability. But if that is the way that they do it, because one spouse is receiving a 50%, basically increasing their ownership 50%, some CPAs will recommend that they wait the 24 months before doing the 1031 exchange to let it season. And some CPAs might say, it's community property, it was community property, blah, blah, blah. Maybe you are eligible to do it right away. But again, another reason to bring in the CPA, especially when it comes to divorces and those kinds of separations, so that you can get the proper tax advice on that. But I did think it was interesting that a divorce would allow for no waiting period on the 1031 exchange because of the change of circumstances. They can just take their 50% and go their separate ways. So it's something that you can help guide your investors through if that's what they need to do. Of course, they may opt to just split the number. If it's more than one property, they may opt to just, you get one, I get the other, etc. But if they only have one investment property, you may want to help them separate that and put them in their own individual properties separately. So something to think about. Another situation that comes up is a failed exchange. So if you're in a 1031 exchange, let's just say you're identifying three properties, and the first two properties they just fall, you find a cracked foundation, or you find some reason that those two properties, they fall out of escrow, or maybe they weren't able to get the financing that they thought they could get, and they just didn't want the property anymore. I think it's pretty prudent as a investor agent to have a backup option for your clients. So one backup option I see utilized the most is a Delaware Statutory Trust. So basically, a sponsor company goes out and finds a large multifamily property. They put it through FINRA regulations and they get it all ready to sell. And then they sell ownership in that property to 1031 exchange investors. So if your investor needs to buy something for $1 million with a $500,000 loan, they can go ahead and put their $500,000 cash into this DST. The DST already has a loan on it, most likely, so they get assigned into that. They don't have to do any loan qualifying or anything, and they have successfully done their 1031 exchange. They don't have to pay taxes. So I know the DST is not ideal from an agent's perspective, as far as the return for your client is not going to be as high, and they cannot pay commissions in most circumstances. So I know it's not ideal, but I think it's a really great backup option, because your goal is to find them something else. But if you can't find them something else, it's going to really sting if they have to pay taxes on top of that. So the DST makes an excellent backup option. It's a very large industry now. You may have even had a DST advisor come speak. There's always going to be like 10 to 50 options available for them if they want to go into this type of an investment. So just something to keep in your back pocket. If you feel really comfortable about the replacement property, and maybe you've already released contingencies within the 45-day period, then I wouldn't worry about it. But if you come down to like the 40th day and you're like, okay, I don't think this is going to happen, these are unlikely for them to close on, then maybe you want to consider like, hey, let's put a DST on here as a backup option. So definitely something to consider. It will save your 1031 exchange. If you're at the beginning of like a 5-property portfolio sale and the first one goes under and they don't pay taxes, that could jeopardize the other 4 properties that they may have been looking to sell. So it's always something to have as in your back pocket. Okay, so converting a primary residence to an investment property and vice versa. So let's start with primary to investment. So a lot of our clients, maybe they move out of a property and they move away or whatever, and they ended up renting out the property. Well, as long as they have been renting the property for a minimum of 2 years and reflected as such on their tax returns, they would be eligible for the 1031 exchange. And they would also be eligible for the 121 exclusion. So this type of an exchange takes advantage of the $250,000 and $500,000 of capital gain tax free. They would receive that off the top. The rest would roll into the 1031 exchange, and they would use that to buy an investment property. So 2 of the last 5 years, that's the requirement for the 121 exclusion, and the last 2 years must have been used for investment or business purposes. I did learn something, even after 3,000 exchanges, I did learn something very recently. Was I had an investor who was forced to move because of the military. He was given orders, and I found out from his CPA that his 2 of the last 5 years got extended 10 years to 2 of the last 15 years. So he was eligible to use the 121 exclusion, even though it was many, many years ago. And that was enough to cover all of the capital gain, and he did not need to do a 1031 exchange. So it's something to think about, but that kind of a conversion is getting pretty common. So it's definitely something to know. The other side is a little more complex. So when you're transferring investment to primary, so post 1031 exchange, 1031 exchanges are only for long-term investment holding or long-term investment property. So post 1031 exchange, you must hold the new replacement property as an investment property for a minimum of 24 months. And that's the safe harbor guidelines. There's lots of case law that supports 24 months as the safe harbor period, meaning the IRS is not going to come after you for a conversion, after 24 months. Anything under 24 months, I would say, is a little risky. I have had clients do it. Anything under 12 months is short-term capital gain tax. So you will not get away with that. But if it's between 13 and 24 months, consult your CPA if they feel comfortable that that met the requirements, then that's fine. But I always recommend, please just take the safe options, do 24 months before you convert it to a primary. If you convert it to a primary, you may lose future eligibility to do another 1031 exchange. There's no taxable event because the property hasn't been sold, so you won't have to pay all of those capital gains taxes, but you also kind of end your eligibility for a future 1031 exchange. And the way the IRS curbs people from doing this is you will not qualify for the 121 exclusion again, your primary residence exclusion, for 5 years. So basically, from the date of purchase of that new replacement property, you'll need 2 years as an investment property, and then 3 years as a primary before you would re-qualify for the 121 exclusion. Now, they really don't want people doing conversions or having the intent to do the conversion. The 1031 exchange is really for the intent of long-term investment use. I'm just letting you know this is the criteria for those exceptions to the conversion. So always consult your CPA before you do a conversion, but this is the guidelines that all of my clients operate off of. So Revenue Procedure 2008-16 kind of helps provide some additional color to what that looks like. But yeah, it is possible, but it does have its restrictions. A lot of our investors, especially some of our investors, they're selling their property in La Jolla on the coast. Beautiful property, but far exceeds the 121 exclusion, $500,000 capital gain. So for a lot of those people, they're going to move out, convert it to an investment property. They're going to keep it for a minimum of 2 years so that they can do a 1031 exchange in the future to limit their tax liability. So it's a long-term play, but it does have its value for certain people. Any questions on this? I know it's a lot of information for converting primary to investment and vice versa.
There was a question a while back. Can you purchase more than 3 properties?
Yes, so you can purchase more than 3 properties. You would have to use the 200% rule for that. If you don't use the 200% rule, there is a sort of last ditch effort guidelines. So there's something called the 95% rule. This means that if you exceed both the 3 property rule and the 200% rule, you must close escrow on 95% of your identified property, which is 100% for all intents and purposes, right? So that 95%, if you do not purchase 95% of your identified property, then you fail the exchange and you have to pay all the taxes. So it's high risk. Yes, if you can get all those properties under contract, remove contingencies in 45 days, then yes, technically you could do the 95% rule and kind of risk it. But if one of those properties falls out or falls through for any reason, then you would likely have to pay taxes. So it's high risk, high reward. It is possible. Don't recommend it. If you can do it within the 200% rule, I think that's ideal. But yeah, it kind of depends. Great question. Yeah, like go ahead.
I got a question for you.
Yeah.
So regarding the conversions that we're talking about right now, the converting to, converting from. So I once had a client that had, it was primary resident. He lived in there for like 15 years, raised his kids, converted it to a rental,
Right.
rented it for 25 years. I think he depreciated everything. Then converted it back to a primary resident.
Right.
And then sold it. What's the taxable gain or taxable consequences for something like that? Is he having to pay recapture on depreciation? Is he having to pay, and at the time it was, it was $500,000 was the total of the sale. So it wasn't a big dollar sale.
Yeah. Right. No, that's a good question. So I do want to defer that to a CPA just because that gets complicated. It might be prorated. So what they do is they'll take in the length of use for investment versus length of use for primary. And they might have like a cap on like how many years they're going to go back when they do that calculation. I've had clients do that before, so I know that it's done, but I don't know the math on exactly how they did that ratio. So I don't have the answer to that question, but that's a good question. Like that's another reason, consult the CPA, find out what that liability is going to be, because it's likely going to be prorated in that circumstance.
Okay, so that's a complicated calculation to figure out whatever the potential taxes are. Backing up a little bit, the situation you were describing before, I had a client 2-3 years ago, had a situation where he got a divorce. Mm-hmm. He was option 3 and got full title to the rental property.
Right.
And then when he sold it, purchased another rental property and then converted it to primary residence, because the wife kept the original house. He got the rental house.
Right.
So you can see how that goes. So is he at some point in time, if he sells the primary resident, going to be liable for the capital gain for the tax? Basically, is he going to be taxable event when he sells the property?
Yeah, from the exchange, he may have tax liability from that. I know there's also some exceptions for change of circumstance. So like that situation, he got a divorce and was forced to move into the property. So that may give him an exemption for that circumstance. But again, yeah, I would want him to go to his CPA to see exactly what those circumstances were, since I don't follow.
Okay.
Yeah.
Okay. And then you were kind of inferring on this last, your last explanation was somebody bought a house, lived in there a bunch of years. It's in La Jolla. It went up a tremendous amount. It was primary resident. That the $500,000 exclusion, you're basically saying, yeah, that's a drop in the bucket. So what you inferred was if they sell that property, or if they convert it to a rental, rent it out for 3 years, right?
Right.
Then they could then buy another property, rent that out for 2 years, and then move back into it, and then defer all of that potential taxable income. Is that correct? Is that the way you were
well,
describing it?
I was describing it more. So I'll describe one thing first. So there's the step transaction doctrine. So anything that you do that avoids you paying taxes, that is really close to the transaction period, can trigger tax liability. So I'll give you one example of that. If you have a person that's selling an investment property and they do a cash out refinance right before the 1031 exchange because they want to change the debt to equity ratio in the property. Well, when they do the 1031 exchange, one of the requirements is that they get a new loan of equal or greater value on the purchase. So because they're they're just increasing their loan value and taking equity from the sale, that could be taxed. If they get audited, they will have to pay back taxes for that step transaction decision. So when you come to, so like your example there, this primary to investment conversion, what I gave this example for, and we're doing it for a client right now, is she was selling a property in La Jolla. It's worth a lot of money. And she knew she would have to pay all these taxes. It's over $3 million, right? So what she's doing is she's renting it out for 2 years. And then she is going to do a 1031 exchange and with the balance, and that she's married, $500,000 tax-free. So the $500,000 she's going to take and she's going to go buy another primary residence. And that's going to be her primary residence with the tax-free money from the 121 exclusion. But the money from the investment portion is going to be a 1031 exchange into a multifamily property. So she's not planning on using that for personal use. Now, I guess, could you technically eventually move into one of the units? Probably, but I would definitely recommend consulting a CPA before doing that.
Okay. So if she did in that situation, say, I was sold this a long time ago, which is go and buy a builder's model unit. Buy it while the builder was living, using it.
Right.
It's got all the upgrades and all that stuff, and then you rent it back to them, and so they're your renters. And then after so if you did an exchange, bought that property, rented it out for a couple of years to the builder while they're building that project, and then convert it back to a primary residence. Does that make sense?
So you're buying a property that's not yet complete, is what you're saying?
No, it's complete. The builder's using it. The builder is using it as their model home.
Oh, yeah, and there's a certificate of occupancy and everything is good, then yeah,
Sure.
that counts as an investment property.
Yeah. And so they rent it in essence to the builder for a couple of years while they're finishing out their project. And then when the builder moves out, then they can move in and convert it from the rental back to the primary residence.
Right. I mean,
and it's the home of their dreams. And if they never, in these situations, if they never end up selling after that, is there a taxable event, say upon death? And
correct.
Do we go into
there is no taxable. So their heirs would receive a full step up in basis, and their heirs would pay none of those deferred taxes. So that's the beauty of the 1031 exchange.
Yep. Lots of ways to manipulate things. All right.
Hey, thank you for the questions, Jim. And like I mentioned, all of this is all about timing. And that's why a lot of these strategies, they take time to implement. But if you know how to do it and you have a good CPA, then you can really make your portfolio work for you. So that's the beauty of the 1031 exchange. And especially with these conversions, it's crazy how much tax you can defer utilizing these strategies. So it'll be good to kind of run these by your clients as these situations come up. And that's kind of why I wanted to do these situational 1031 exchange conversations, is because there's so many different things that can happen, so many moving pieces, and no one deal is the same as another. So we're happy to help consult, and our attorney Paul is happy to help review anything that can help your clients make an informed decision.
Great, thank you.
Of course. Let's see. Any other questions on conversions? Wanted to give anyone else a chance.
Yeah, Adam, Sissy has a question. She asks, when you say the owner may not qualify for another 1031 exchange after converting the primary residence, is it only for that property or is it for all their investment properties?
Great question. So it's only for that property because it's now a primary residence. It's not eligible for an exchange. But all the other properties, they can still keep doing 1031 exchanges. So good question. Perfect. So there's always legislation on the counter for removing the 1031 exchange. Every single person that comes into office seems to try to get rid of it. But so far they have failed because it really does generate a lot of revenue. Almost over 25% of all residential real estate sales are investment property, and a lot of them are 1031 exchanges. So the amount of people that are employed off of that when it comes to state and local taxes, it generates a lot more than it would generate if they got rid of it. So that's the good news from the 1031 exchange standpoint. From a landlord standpoint, or I'm sorry, owner standpoint, in California, there's always legislation to tighten rent control, and SB 567 is the latest attempt by the state to go ahead and put the screws to anybody that owns investment real estate. So a few of the changes that are proposed, and these are amended changes, they keep changing the bill. The first iteration that came out was atrocious. It was insane. It was one of those things that you read and you're like, this isn't real. But fortunately, they've kind of backed off on a lot of it, but this is what has so far remained. So cap on annual rent increases at 5% plus the CPI, or 10%, whichever is lower. So you're capped at 10%, basically. Requires just cause to take effect immediately. So that's a big one. Just cause or no fault evictions. Just cause is just getting harder and harder as far as what's allowed. So they want that to take effect immediately. It requires an owner. So if you say you remove a tenant because you want somebody in your family to move into the property, which is one of those no fault options, they have to move in within 90 days of terminating the tenancy and occupy the property for 1 year. So that's pretty reasonable from what it was. The first iteration of SB 567 was you had to move into the property within 90 days and you had to keep the property off of the rental market for 10 years. So, and the way they were going to enforce that was make you record a deed with the county assessor's office. So kind of ridiculous. Fortunately, they backed off of that crazy effort. So now it's within 90 days and occupy the property for 1 year. They changed the substantially remodeled definition. You have to be a lot more exact on what you plan on doing to the property, and it has to be a remodel that would take longer than 30 days, or else you can't make them move for that reason, or they have to be able to return, like I mentioned, at the previous rental rate. So kind of ridiculous that you would improve a property to then move them back in at the same rate that they were paying initially. But yeah, and then the bill would also authorize the attorney general and city attorney or county council within those jurisdictions to bring injunctive relief against the landlord. So the difference there is it's attorney general instead of just the city or county legal counsel. So that's a little bit of a change of who all can go after an individual investor. So SB 567, keep your eyes on that. They keep trying to change all the rent control models and all the fun things we deal with here in California when it comes to investment property. But keep your eyes on SB 567. So what resources do we provide? My goal is to make the 1031 exchange really seamless and easy for, especially for you as the agent. So I want to be able to help you do the consulting, whether that's in person over coffee or via a Zoom call or a phone call with everybody involved. I'm happy to reach out to their CPAs on your behalf and kind of get information that ways. Anything I can do to help make the transaction seem really seamless. So really feel free to use me as that tool. I love going to coffees. All the information I gave you today is obviously a lot more than I would discuss with any individual investor unless they asked about something specific. I'm going to be sending Lindsay a copy of these slides if you would like them, as well as our one-page exchange guide. I think the one pager is nice for investors because it just kind of goes over the basics and makes it seem a little simpler. And because we're the ones that will guide them through this transaction, and we want them to feel at ease with our ability to do so. So hopefully you can take advantage of that. And if any of you individually after this seminar would love to get coffee and just brainstorm different marketing ideas, I'm also happy to help on that front. You know, we have some marketing materials. I can take the exchange guide and put your information on it so that you can send it out. I want them to come to you first and then bring me into the picture is ideal. So anyway, I can help you guys get more listings. Just don't hesitate to reach out. Thank you again, Lindsay, for letting me speak to you guys again. It's been a couple of years, but we're happy to be a resource. And I think I'm leaving you guys a 10-minute break before your next webinar. So at this point, if you guys have any questions, don't hesitate.
Thank you for being with us, Adam. Great information. Anyone have any questions? I don't think so.
Perfect. Sounds good. Well, thank you everybody for allowing me to speak, and I will be in touch. Thank you so much, Lindsay.
Thank you, Adam.
Thank you.
Bye, everybody.
Have a great day.